Hello again. This is Josh Carr with Real Angle, and today we're going to be talking with Laura Rapaport at Northbridge. Laura, how are you doing today?
I'm great. Thank you for having me.
Cool, cool. So one thing I always like to start with, just because if I don't, everybody immediately asks because the internet needs to know. So that's northbridgeops.com, northbridgeops.com. That's their website. I always like to get that out at the beginning because invariably someone always asks. So let's talk a little bit about Northbridge. So let's start with the basic stuff. Where are you based? What do you do there?
Ooh, thank you. So I'm the CEO of Northbridge. We are a women-owned national CPACE lender and servicer. We are active in every major market, but we sit in New York City, and we have a team of people who all come from the institutional real estate world. So we have been everything from borrower, lender, lease space, bought space, sold it, refined in the middle of construction, put projects on hold, value engineered. We've seen it all. And with that, also come to it from the sustainability world, having used sustainability as part of many of the projects we've done. So Northbridge is really sitting at the intersection of real estate and sustainability, and CPACE is our first product.
So yeah, so you've said the magic word, which I think we got to talk a little bit about because the knowledge penetration on what CPACE is, frankly, just isn't there. So what is
Getting
CPACE
there.
financing?
It's getting
I
it's
know it's getting there, but we're not there yet.
no,
We're not there yet. And it's
no.
a so what is CPACE? And then we'll talk about state by state also why it's not there. But what is CPACE financing?
And I'm not offended when people say I don't know what CPACE is, and I say I know you don't. You haven't used it likely, and let's talk about what it is. Let's start at the 30,000 feet, go into the weeds. So you
Great.
can't know be responsible for knowing something you never heard about, used before. And in my mind, the worst question you can ask is the one that you don't ask. And so it's important to ask the why and what is it and how can it be used. It's been around actually surprisingly for people since 2008, but between '08 and 2020, so for the first 12 years, there was $2 billion of deals, done over 2,500 deals. It was very small scale, and it really started to incentivize people to put uh, um, more sustainable measures into their building, have an industrial building and add solar. And the idea was that the cost of the financing over the useful life of the improvement would be cheaper than the savings that you achieve. But as you and I well know, when you put a geothermal plant or you add in new elevators or you put new windows or add solar, the upfront cost can be cost prohibitive. And you won't, even though it's the right thing to do, and many times now there's laws coming into place telling you what you have to
You
do,
have to do it, right.
but and or your investors want it. Sometimes it just doesn't. It just hasn't penciled. And so, what I think is so interesting about Pace is it becomes a product that can actually make these sustainable elements work. But sustainability in the institutional world is a very, very foreign concept to most. I think people are now having ESG mandates and they don't know what it means. But another conversation or later in the conversation. But back to Pace. Pace is a form of long-term fixed rate financing. It is a fully amortizing piece of paper and pays for energy efficiency, water efficiency, seismic resiliency improvements. And what that means in layman's terms is your building envelope, curtain wall, windows, doors, and roofs to all of your building systems, as well as elevators, escalators, and your renewables. When I first heard about PACE, I thought, well, I am a very pro sustainability and making buildings better. But as I look around New York City, like what on earth would qualify? And I was actually shocked that, and we can talk state by state, what actually counted. Because in most places, if you build to code or you're building an institutional quality building, you don't have to be passive house. You do not have to be net zero. We fully
Right.
encourage you to do that. I mean, we think that's fantastic. But
Right, but you
if
don't have
you've
to.
actually built an institutional quality building, you are PACE eligible without even realizing it half the time.
And mechanically,
So
as far as the debt goes, it's basically sitting essentially in front of the first mortgage, right?
so let's talk about that. So
Yeah.
yes and no.
Okay.
So PACE, this all sounds great. I have all these improvements. We paid out, we are an assessment, we're not a mortgage, and we are paid out through an increase in real estate taxes. So if your taxes were $4 million before and your PACE payment is $1 million, your new tax bill is $5 million. It's a non-ad valorem tax. It does not impact your ability to contest your taxes. It does not impact your value, and it can be taken out at any point in time. So there's a couple kind of key things that people get confused about. One, PACE is fully amortizing over the term, over the 25 or 30-year term, which is the useful life of the instrument. However, it can be taken off at any point in time. It is fully prepayable from the moment I disperse the funds. It
Okay.
is all private credit, so depending on who your lender is and how it's structured, there may be some form of call protection or yield maintenance, depending on the duration. But you have the flexibility as borrower or lender to take the PACE off at any point in time. It is fully transferable. We do not have the rights to say you can sell to this person, you can lease to this person, you can, take capital from this person. It is fully transferable. And so it is at the option of the borrower or lender to keep the PACE on or off.
Right. So unlike a mortgage, which has to be paid on sale, so
And
mechanically,
then lastly, it can
yeah.
never ever accelerate. So when you say we sit in front of, that's I think probably the most important point that
Okay.
people who even think they know about PACE, but maybe haven't done, don't realize or fail to remember, because we say, oh, it sits ahead. And that's probably the more conservative view, that you have this, $40 million lien sitting on your property, but in no scenario can I ever accelerate, but I can always be taken off. And so that's where we're different from a first mortgage or for a ground lease. We can't ever accelerate. The only amount that sits senior to the first mortgage or the mezz or anyone in the stack is the amount that's due. Now there's 3 phases to PACE. You can accrue, which I think is really kind of neat structurally for this market. You can accrue for, let's say, 2 years. We will prepay our interest into escrow at close. And there's nothing due at that point in time. There's nothing that primes the first mortgage, but you can always take us out. Then we can go to an elongated IO period, 2 years, 5 years, 8 years. And
Okay.
at that point, only the interest payment sits senior to the first mortgage. Again, the outstanding principal balance still passive. And then we will go into amortization. So what is a 25-year fully amortizing piece of paper can actually now be structured as 2 years of accrual,
Okay.
8 years of IO, and hype around 15 years at the back end. But what I've done is I've created a synthetic 10-year accrual fixed rate IO instrument that's not available in the market now. And we're fixed from inception. So it's becoming, before we get into all the ESG benefits, as a capital markets tool, it's highly, highly accretive now. From a structural standpoint, a lot of people get very confused, don't know where we sit. Top of the stack, bottom of the stack, who are you? What do you want from me? What are you taking from me? What rights do you have? The answer is none. And from a structuring standpoint, the other thing that's really interesting in this market is it can be used on a go-forward basis. It can be used for new construction, renovations on a go-forward basis. But where we're seeing a tremendous amount of interest in the market is the retroactive look back. You essentially get reimbursed with looking back to 2 to 3 years from when you had TCO. Your TCO was at the end of 2020. We can give you money today for money you previously spent. And so with that, once those dollars have been spent, they're fungible to the borrower. They
But
can,
but just to back up for a moment,
yeah,
just mechanically. So a
sure,
few basic questions just to get out of the way, because again, I realize that for a lot of people this is very new.
please.
So mechanically, um, I borrow X amount of dollars to go pay for improvements, insulation, solar, whatever it is. Now, the city essentially, then I'm paying my property taxes, I'm paying this extra assessment. The city, the municipality is collecting that money. Then they're essentially sending that money to you, if you're the lender, essentially, to go pay what needs to be paid. And then essentially, it, as you said, it gets amortized over 25 years. And I understand that there could be complexities to it. You could, as you said, there could be an accrual period, there could be an interest only period. We can structure it all kinds of interesting ways. I love the fact that it's transferable, because basically when I sell the property, it sort of rides along. So
Or
here's a
you could
question,
take me out.
or I
So you
could
have the
or I could pay it
option. You
off.
can have the asset free and clear or not. It's at your option,
I
depending on
could do it, the
how
new
it is.
owner could do it. We have options. So here's one question that I've always been curious about. So I have to pay the city property taxes. I have to pay them this extra tax, if you will, this assessment which flows to the lender. What happens if there's non-payment on the part of the borrower? what happens?
Somebody wouldn't pay their taxes? What are you
I
talking
know. Well, it happens, right?
the
So
idea.
so like I know with a mortgage what
Yeah, I'm
happens,
getting
right?
that.
You have a lien, there's a foreclosure action, all that kind of normal stuff. Is it mechanically similar? Is it that is there a tax foreclosure? How does that work mechanically?
Great question. So basically, PACE is paid whenever real estate taxes are due. So twice a year in California, once a year in Pennsylvania or
Four
Florida.
times in New Jersey, sure, different markets, different
We're
systems.
not yet live in New Jersey, but yes, you get the idea. So
Right.
with that, the payment sits like a bid tax on your tax bill, as it's a non-ad valorem payment. In some jurisdictions, it's a separate bill altogether. But in short, if you don't pay, let's talk about that capitalized interest period, IO period, amortization. If you don't pay me during the capitalized interest period, there's nothing due. We have already paid myself. So you've already bought yourself a period of time. If in the IO period, and let's just put numbers to it, let's say it's I don't know, a $15 million loan, and we're going to accrue for 2 years. So our kind of total finance amounts, call it 16 and a half. Rough justice will pay 15, million five a year, just round
Sure,
numbers,
sure, 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 sure.
twice a year. So let's just say your your payment, million five. In that period, as long as if you don't pay that, that will accrue at the local default tax interest rate.
Okay.
The as long as that payment plus the tax default interest is not paid, it will then accrue for another year. Usually it's call it 2 years before we could even start to enforce a tax lien foreclosure. That's our
That's
only goal.
most jurisdictions. You get a couple years to catch up. Afterwards,
Yes.
sure.
If at that point we haven't been paid our $3 million and whatever the default interest is, we can then enforce a tax lien foreclosure to recoup the outstanding dollars and interest, not the outstanding principal balance, but the money that was missed for a tax lien sale. However, at any point in time leading up to that, either the senior lender or equity or anyone else in the stack, because stacks are complicated these days, can pay us. And once we are paid, we go back to our regular scheduled programming of paid once a month.
Right.
There are some things structurally we can talk about that the lender can put in place to protect themselves. But really, at the end of the day, the reality is that the lender will likely pay us off, cram down the equity. Now, question is, okay, well, we go to a bankruptcy or foreclosure. What happens to the payments? Well, as long as we're still being paid, we're silent on the sidelines and we let the lender step in to enforce the bankruptcy or foreclosure. Because for us, we're passive, we're real estate taxes. As long as our taxes are being paid, we're fine.
You keep going. Sure.
Yeah,
Nothing really
and I
happens.
think it also goes to talk about how we size these deals because we're not an 80% or 90% piece of debt. We are sized the lesser of three tests. The first is a 30% LTC or LTV, but who knows what V is these days, but call it
Right.
LTC
Sure.
structure. But the V, actually, interestingly enough, is based on the appraised stabilized value. So that could be 25, 26. It's not saying, hey, I want to know what an office building's appraised for in November of 23. That's not ideal.
Right.
The second is a 1.0 DSCR, sometimes a little bit higher. We call it 1.0 DSCR, based on your stabilized NOI and your fully baked debt service. We are not loan to own money. We do not want your property. And we want to make sure that you can pay your lender
Right.
when you're stabilized. And because of this capitalized interest, we have the ability to give people time to stabilize. And then lastly is your 100% of your PACE eligible measures, because in a market like New York City, far less will count than a place like California if you build, to code. Seismic resiliency, for example, counts. And we take the lesser of those three tests. So we're somewhere generally between, I mean, we're working on a deal now sub 5% LTC, or LTV, but we're probably somewhere in that 20 to 30% of the stack. So we are not, while we can be a larger part of the stack than historically PACE had been. I started talking about the history of PACE, but we are not the largest piece of the stack. Although now with a lack of A notes and a lack of liquidity, PACE is now taking a larger piece, and we're looking at some projects where we
Right.
can.
So just to dumb that down, I think as you're saying, I mean, as credit has become tighter and people need a way to get things funded, it starts to make more sense to say, well, gee, if I make this thing more energy efficient, now I can go finance some percentage of my project, whereas previously I might not have used your money for that, basically.
Right, or actually, and the other thing that we're finding a lot of is to the retroactive nature. We're actually just completed a deal. We're doing another one right now. The retroactive nature. We're coming in for assets at or post TCO. So we actually just closed the largest hotel C-PACE deal in California, and the largest hotel C-PACE deal this year, which was $50 million. And it was alongside two debt funds to take out the senior and mezz construction financing. The asset
Got it.
opened at the end of 21, LEED Gold building, and the financing was due. And so we came alongside a senior and mezz to take out the PACE. And because of the retroactive nature, 100% of our dollars could be dispersed at close to the borrower to pay down that
Because
funding.
all the work has been done already.
Exactly.
So
Exactly.
now, silly question: why wouldn't they have come to you before they started the project? Is it just they wouldn't have thought of it back then? Because
They
maybe
may have.
okay,
They may have. And I look, the project was completed in 21. So when they were working on building the project, there was a lot more money in the system.
right? So they didn't have to think about using, lack of a better word, an exotic product or
It was new, there was so much money, and I think that's one of the reasons why a lot of people haven't dealt with PACE. It was mispriced for a long time. It was at, call it L plus 500, when you can get all-in financing sub 3 for
yeah,
80%.
yeah.
And if it was, small dollars, it wasn't worth it for the institutional group. Fast forward in a post SVB world and no capital markets movement and all of these new regulations on banks, people are saying, okay, what is this PACE thing you're doing and how can I use it? Where is it most effective? Can this be an accretive part of my stack? And
Sure.
I think we've seen a wholesale change in the size and scale of how people are thinking of using PACE today. So that's
So
part of it.
so this shifts it to another part thing I wanted to ask you, which is how are you? Because you've got a product which is before was more of an exotic, if you will. It's getting to be more used by people. How are they finding you? How are you finding them? I mean, because you're not a bank, right? So how are you actually finding borrowers? How are borrowers finding you?
Relationships. All of our deals have been through relationships. We work with brokers, we work with lawyers, we work with borrowers
Sure.
and lenders, frankly. Some lenders have said to us lately, hey, wait, our pricing is going to be too expensive, but mixed with you, actually, we can get our proceeds out
Right.
and the pricing, and that's attractive to a borrower. So I think that as more deals are getting done, as banks realize, because there's lender consent has actually been one of the biggest reasons why people have not used PACE to date. Lenders need to consent, lenders, other lenders in the stack, the
Right,
Med,
because you're part of the you're ahead of that. You're ahead of them
right.
in a
We are an
sense. Right.
assessment, we are a lien, and we require lender consent as part of our application, a part of our ability to put PACE on a property and it transfers with the property. We require the lender to consent to our being there. And the lender consent documents can be from, 4 pages to 50. It just depends on who the lender is and how complicated the transaction. But all that said, and it's not intercreditor, all that said, a lot of lenders didn't know about it, just said, no, we don't do it. We just don't
Sure,
because
because it's
no one's
non-standard.
appropriate. We just don't. And
It's
so real
non-standard.
estate, no one took the
Yeah.
time to learn about it. And so I think as part of that, the use case now has changed where brokers are saying, actually, instead of let me fill the stack and see if there's space and I'll bring you in at the end. Hey, the only way this deal is going to get done is if there's pace. And all the lenders vying for this also know that. So let's see how much you can do. Give me a term sheet, and then I'm going to go out to the market. Or if you have your favorite bank, bring them in, because at this point, certainty of execution is what wins these days. It's not about fighting for a basis point, it's about
Right.
proceed.
It's about getting it done. No, and your point about aggravation factor for lenders is well taken. I mean, and I get it. They want a standard product. I mean, I don't know if it's still the policy, but for years, and I just know this because of a family matter, Fannie Mae had a policy that if the town line cut through your house, Fannie just wouldn't fund it because Fannie was just like, it's too annoying that your house is legally in two towns because then we got two property tax bills. So we just don't want to deal with it.
Yeah.
And You'd say, but why? They'd be like, because we just don't want to. Like it's irritating.
Because in the
Because
and
because
by
then
the
we'll
way,
send the wrong amount of money to the wrong town, and then we'll have to go get the money back, and we're Fannie Mae. We don't want to worry about this. You know.
and yeah, it's funny you bring up Fannie. So Fannie will not allow PACE. Freddie
Okay.
will. It has guidance. It hasn't done one yet, but they're really trying to work to see how it would work. And that's also, again, part of the takeout. But I think as the PACE market has evolved, the
Sure.
PACE market now used to be, very rigid prepay, very rigid structures. And as more entrants, or I can only speak to, to Northbridge, and we have, you know, different types of capital for different types of deals, the structures are very flexible. And so we can actually create situations where we can come on as bridge financing. We can come on as longer term financing. We can structure it in a way that will work if we're taken out on the construction loan at, takeout or not. But the Fannie Freddie, it just in terms of that agency not
No,
accepting has
it's
been
an
a
interesting point.
problem.
Sure. And I'm sure Fannie will eventually get around to it because they will, but they'll
Well,
do it when
also
they
the
do it.
thing that's ridiculous about this is Fannie and Freddie will allow Mello-Roos bonds, and it's also allowed in CMBS. CPACE is the same thing as a Mello-Roos bond that's been around for 25 years.
You want to explain what a Mello-Roos bond is,
So,
just because?
yeah, a Mello-Roos bond is a type of financing that was very popular in California. I give Mitch Clarfield credit for this one added in California. It's like this is the same thing. The Mello-Roos bond is a type of financing that was to incentivize people for district improvements. And the same idea as with PACE, and it would be on assessment. PACE is, and the idea is that you put the assessment on. You'll hear the term public-private partnership, what gets people really scared. I've done public-private partnerships. This is not that type of
Right.
public-private.
This is,
And
and
it's
what I
all
like.
private credit, the public
Right.
side, because people are like, oh, this sounds interesting, but I don't want the New York City, you know, economic development corp
Right. Right.
not
But
involved.
you're
So
not
tell me
involved
what
with
to do.
public.
It's none of that. So I
It's not
also
public.
want to clear the air on that.
Sure.
When people say public-private, it's each state opts in and each local municipality opts in to allow you to actually have an assessment on your property. After that, it's all private credit.
Sure.
And there are certain guidelines by state as to what you can and cannot do. But it is not them saying, I'm going to, and there's no ongoing tests either. I think that's a really important point. There's also no mortgage recording tax. So it's not something where people have the local government looking over their shoulder. And I think that's one of when people say public private and the government's actively involved in the project, this is all of
That
the capital is private credit. We'll have different guidelines in terms of how we're underwriting our deal versus another PACE lender. There's certain guidelines that are required by the state of what you can and cannot do that's quote unquote eligible. And states are starting to continually revise and revisit and improve their programs as the product becomes much more mainstream.
right.
But it's the idea of this, the whole idea of PACE is that you can put it on your tax bill as an assessment because you're creating a benefit for the people in the building. And so that's the same idea as a Mello-Roos bond, which is
Well,
allowed in CMBS. PACE is not
and it's
historically and
interesting.
now will be.
I also say it's interesting in that, as opposed to most financing structures, considering the whole point of these financing structures is to put in improvements that make buildings more economically viable, right? I mean, lower expenses generally. That's kind of the whole idea, right? As opposed to most financing vehicles where you're just financing the project. This is financing something that in theory makes money. So, if anything, it's making the project better, which I find
Yeah, I mean,
interesting.
I think you pick up on a really good point. A lot of people focus on PACE about it just being a very effective capital markets tool, which it is.
Sure.
However, the improvements you're putting in actually have an economic benefit for the savings you're going to achieve
Sure.
because you're going to be putting in more efficient systems. You're going to be lowering your operating expenses. By the way, you might not be paying a fine because you're now complying with a local law 97 or BERDO, or there's 20 cities and growing
City by city, they're
that
putting in
have
rules
these
saying you have to.
requirements.
Right.
And you can quantify and market the sustainable benefits that you have put in retroactively or are putting in, or both. We're doing some projects where it's both, that actually are meaningful now to lenders for their ESG checklists, for borrowers, for their investors, and now tenants are seeking it out. And we have more and more borrowers saying, my gosh, and I've leased space before. No one ever cared about our ESG checklist. Now tenants are coming and saying, show me all of the ESG features in your building, because it becomes binary. If you have the features, the tenant can move into your building.
Right.
If you do not, sometimes they just can't, because they cannot, as a multinational corporation, be associated with a building that's having fines or doesn't have certain levels of reporting or sustainable benefits.
It's part of their whole right, which gets into a broader conversation about society and sort of
Yeah,
meeting
there's
political
been a
goals, what have you.
shift.
No,
So
there has been a shift. There definitely has been a shift culturally. So, a couple other questions just to throw it out there. So, structure wise, are you guys so Northbridge? Are you a fund? Like, how are you? Where's the
great
money coming
question.
from?
We are not a fund. We have multiple institutional capital sources that range from insurance companies that buy directly for their balance sheet, to asset managers that have insurance mandates and
Okay,
can sell, take something down and sell to one or multiple insurance mandates. We've seen somebody do three, four, one. It just depends on what their allocation is. And then lastly, also groups who have open-ended vehicles and a combination of insurance and open-ended vehicles.
got it.
So for us, depending on the opportunity, we match the right capital with the opportunity, because people's goalposts are shifting right now. But for us, we focus on north of what I call the large PACE space, the north of $10 million of PACE and greater. Anything. And they're
Right,
just
which considering the loan to cost, it could be relatively small. $10 million of PACE financing is actually a pretty decent sized project.
or it could be really small. I mean, we have deals that are, $100 million that are less than 30% or 20% of cost, because
Right.
there's no reason on $1 billion deal you couldn't do 250 of pace for the
Sure.
right
Sure.
project
Sure.
or
Sure.
more. And so it can also be across portfolios as well. It can be used as seller financing to purchase notes. There's a whole use case of loans. Ultimately, the amount goes on the asset. So it could be a portfolio, could be $50 million of pace across 3 assets, 2010. It just depends on and it transfers with the property. So it's just making sure there's enough allocation on each asset. It could be one asset that's worth $200 million that has, 4 different condo units to it, and we allocate commercial condos. We allocate to 3 of the 5. It just or 4. It
Right.
just depends. It's all about structure, and I think
It's very flexible as a product in terms of how you can
we've
think
and
about
we
it.
I think that's what people find most surprising, that it's incredibly flexible, highly structured, and we're in the early days of really pushing the envelope of what the art of possible. I started my career at Lehman in their European CMBS group. I did securitization number 2. And I think where we are in the PACE world is very akin to where CMBS was in the early 2000s in Europe. CMBS had been around for a while, but really wasn't a highly used tool in Europe. People were dubious of a new product. There was a
Right.
lack of liquidity. And suddenly they realized it was not as terrible. You could sell your asset. It was structured.
Right. And
This
then they
is the
figured
greatest thing
out,
ever. And now, ironically, PACE is taking off because of the lack of CMBS in the market now, because we don't have that efficient recycling of capital to take out these transitional loans, or to pay for portfolios. I mean, there's
no,
just a lack of efficient capital markets. And so I
no,
think it's the same
it's
thing here. PACE has been around for
right.
a long time and has been gaining, triple digit increases year over year for the last 3. Um, so it's just the use case is now front and center, because the cost of capital is so much cheaper than anything else there. It's fixed in a highly volatile environment, and it can be used on a whole use of things, not even getting into the whole ESG benefits, which we think is great to incentivize someone to put in heat pumps over PTAC units. I've
Sure.
spent
Sure.
years
Sure. Sure.
value engineering that in projects.
Well, and it's funny you mention that because I mean, as far as some of the technologies and just sort of people understanding things, because the fact that you mentioned PTAC versus heat pump, I have a colleague of mine. I've done multifamily deals for years, and my business partner of mine keeps referring to everything as a PTAC unit, and I keep having to be like, no, 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 that's a heat pump. And he's like, what's the difference? And I think I've explained the difference between PTAC and heat pump to him now like 5 times,
Yeah.
and I keep doing it because he keeps asking, but I'm on the sixth time I am going to get rude, because like at a certain point I'm like, you're just not listening at this point,
Yeah.
But
Take him on a property tour and you can show him, in the wall versus through
no, and
wall.
I've done that, and I've done that. I've been like, this is through the wall, this is hanging on the side of the building. I pointed at things.
Yeah.
It's just not the switch in his brain isn't flipping. My point is that these are new things, and we are creatures of habit because, of course, we are. And the longer you're in an industry, the more you're a creature of habit. And it takes time for people to understand that, yeah, this actually works and it's viable and it's a real concept. How many states is CPACE currently authorized in? Realizing, of course, that cities still have to sign off on it.
Yeah, and authorize is interesting because, so for example, Georgia, the only place you can do it in Georgia is Atlanta, but not outside of Atlanta. So then
Right. So the
I would say
state law
38.
enabled it. The state law
The
enabled it,
CPA's
but
enabled is 38, and on our website, if anyone ever needs to check, just go to our website. We have a map that we keep updated of where it's actionable. But even then, within a state, there are some places where Tampa, for example, in Florida, not actionable. We've done the largest CPACE deal to date in Florida, and we would love to do more in Tampa, but Tampa's not actionable. Miami-Dade is, so great.
sure.
And
Right.
I think it will grow. It's not, people ask, okay, well, what about the backlash against ESG in some of these Republican states? Texas is one of the biggest states that uses PACE, and same thing with Florida. So it's not, again, I think it's not about having to be passive house and net neutral. If you're an institutional investor, you're going to build to a LEED gold standard likely, or put
Sure.
elements in that are. And if you're an owner operator, you're going to want to replace your windows and your HVAC because it's savings for
Well,
you and
well,
a better
like,
building.
yeah.
Those things also can count. So people say, well, gosh, I don't think I'm doing enough. And I'm like, well, if you upgraded your windows, your HVAC, and your elevators, oh, well, of course I would do that. I'm like, then that all of those hard and soft costs PACE eligible. And while we're at it, to your point earlier, there's some really cool technology we can add in. Would you like to learn about this? Or do you want chargers and
Right.
EV chargers and solar? There are ways for you to now leverage this product, whether now or in the future, to enhance your building, to make it attractive, to get the tenants in place, to keep the tenants in
Right.
place.
To get more tenants who want to pay more money for higher quality space.
Yeah,
No, I mean it's funny. Yeah, I mean you briefly, not to get deep into politics, but it is amusing that whenever you mention anything that's, ESG related, it immediately becomes a political conversation because the way our nation is right now. But like at the end of the day, everyone likes to save money. I mean,
100%.
so if you can insulate the building and lower your expenses, I don't really think of that as a Democrat Republican thing. I think of that as a I want to save money thing.
Balance sheet.
So,
I want to be in the black,
I mean,
not red. So let's
exactly.
save some dollars.
Your
Yeah.
accountant doesn't care. He just wants you to make more money. I mean,
Yeah.
it's pretty straightforward. So, as far as the future of Pace, obviously it's growing, which is wonderful. Um, it sounds to me, and I think I'm going to know the answer to this, but I'm going to ask it anyway, which is as things get back more to normal, because at some point the credit markets will start to function again the way we expect. Maybe we won't have dirt cheap money, but
Yeah.
function. Do you think we're over the hump, so to speak, where PACE financing is now going to enter the mainstream? Or do you think that it kind of like, do we have enough momentum now that it becomes a mainstream tool? I guess is my question.
Yes. This is my own personal view.
Realizing
We're
you're
gonna have,
biased, yes.
18 to 24 months of really choppy waters. I think we haven't truly seen a lot of the credit crisis that we know that's looming. We've heard about this wall of CMBS, and I think we all thought that rates would probably come down a bit more, or there would be more movement in the system.
Right.
And without that happening, and we're now, staring 24 squarely in the face, there's going to need to, something's going to have to give. You and I, were talking the other day about there's somebody who gave their property back at 75% complete. It's a great deal,
Sure.
and they just were over levered, and we're seeing things across the board where over levered, not because they were incorrect about taking the debt. They were very prudent about their underwriting, and they were very thoughtful about, but no one underwrote a SOFR going north of 5, or maybe they didn't buy the cap at the time, and they're getting stuck with a great asset. And so, as somebody the other day said, it's not the asset that's impaired, it's the capital markets, which is going to have a reverberation through that. So all that to say, I think there's a real opportunity with the stress that we haven't seen yet to continue to, I mean, we are drinking from a fire hose. We are actively hiring. We're seeing opportunities across the board from people, from everyone and anyone, because everyone needs money. And even the most well-capitalized groups are having a hard time getting some of the financing. Not on every project, but enough that it's really making PACE front and center as a viable option for people to use. They think, oh, it's so hard, and then they actually learn it's actually there's nothing hard about it. There's very few documents that go with it. Our documents are very straightforward and we have no rights. And then they say, well, wait a minute, this is an opportunity for me. Maybe I don't want other lenders to learn this because this is another
Right. This
our
is
mind quiver.
sure,
But
sure, sure.
along those lines, I think therefore, it will become larger, more widely used, and more people use it. Pricing will go down as volume increases, and then when the markets come back, it's people are familiar with it and know about it. I was out in LA last week for ULI and meeting with someone, and I said, he had been doing some homework on CPACE, and he said, oh, well, at this point, everyone knows what CPACE is. I'm thinking, well, that's not what I hear every day. Because some
That's
people
not the
say,
case.
what is this? And again, I have no problem starting with what CPACE stands for and how they can use it or where they shouldn't. But I thought that was such an interesting change.
Uh,
Um,
Early in my career, I worked at a firm that did a lot of brownfield redevelopment,
oh,
and
I found that.
and at the time when I was working at the firm, the feds had just changed the rules to talk about you could put in, liability protections for potential buyers. You could have prospective purchaser agreements with states, and that was all new law. And this was be the '90s, and it takes time. Like, it was a cool concept, but it still took like a decade or so for the industry to be like, hey, we can do this. We can actually buy contaminated sites and take them through the cleanup process, and these legal mechanisms are meaningful, et cetera, et cetera. It takes time. It takes time. It's an educational process, and that's unfortunately the role sometimes people have to be in. You end up being an educator even though you weren't planning to be one.
Yeah, I don't mind that. I think it's so interesting as a tool. And when I first learned about it, I was like, what is
Sure,
this? And
sure, sure, sure,
I
sure.
asked the smartest people I knew, and they were like, I don't know. And having sat, I personally done leasing, bought buildings, sold them, built them, refied, managed, owned.
Right,
I've sat in all the seats. I'm thinking, gosh, this is such a cool tool that is so misunderstood and also mispriced for what it is. And I saw the opportunity for tremendous runway and innovation, and continuing to see as it evolves. What's exciting for myself and the team is just how we can use so many of the structures that already exist in commercial real estate and other parts of structured finance to apply it to this as a way to help unlock deals, to be that positive thing, more passive. I don't want to own these properties, but I want to help unlock them, and I want to get the borrowers and lenders the correct execution and success. And by the way, while we're at it, make each building that much more efficient, one building at a time. And then
right.
I feel like we will have done a good job.
No, look, this is all very positive. So, what I always like to ask, just as one final question, just to throw it out there, you've worked on a number of CPACE deals, a number of other transactions. I always like to ask if you have if you have any deals that things that didn't work out as expected, and that could be for good or for bad. I always like to ask people if they had anything go in a
Never happened
strange
to me
way.
before. Everything's been perfect.
I know,
It's funny. I was saying to a colleague the other day, I said, something always comes up on every deal.
I know, I
And it
know.
will change, and that's okay because um, issues don't kill deals, surprises do. And so we can get through issues. We can think outside the box. We will figure this out, and we will learn from this one to be even better on the next one. I think that in every deal we have seen things that have been unexpected, even
Sure,
non-CPACE deals. There's just always something that no matter how diligent you are, and I like to be very diligent, as is the team, uh, there's something that will come up or the market changes. The
right.
deal that some deals have taken a long time. And so where the, 10 years started was at sub two,
Yeah, I know.
and it
The
went
money was
to
free. I know.
four, and then last week it was at five again, and then
Yeah, which
coming
is
down.
real numbers.
Those are things that have gone wrong, that are things out of our control. but we've been able to fortunately accommodate. The deal that I'm referencing with a two, we didn't start when the tenure was a two, but
Right.
that would be a really long deal. But I think I think that you learn from when things go wrong. 425, for example, a building I built over many, many years. We thought we broke ground in May of 2015, and the asset's now open, and things take time and surprises come up, and you kind of go with it. And again, I feel fortunate to have worked on some deals that have had problems that we've been able to get through, because that's when you learn.
That's when you learn. No, and it's well put. I mean, I've every deal I've ever worked on when a broker's marketing it, I always say to the broker early in the process, like, what do I need to know? Because like there's always something weird. So when you tell me nothing's weird, I know you're lying. So just tell me what weird things you know about now so we can just get it out of the way and we can move to the actual making a transaction happen.
Well, it's also like in the market today when people say, I said, how are things going? They're like, well, I'm like, well, if you told me everything was great, I know you're lying,
You're
because
lying.
there's everybody,
I know. I know.
everybody, everybody, no matter who you are, has a problem. It could be capital P, lowercase p. You might not even know what these problems are, but we are in uncharted territory.
Yeah.
And some deals will be totally fine and are well protected and are fine, but a lot of deals that otherwise even 6, 12, 18 months ago would have been in a different state, just given where we are in the market and the cost of capital, because of everything going on in the system, the reverberations through the system has really caused people to change, needing to put more money in. I mean,
Right.
a broker said to me the other day, if you can get me to 65% leverage, like, that's amazing. And I'm thinking, wow, that used to be like 80.
That used to be the low end number. That used to
That
be
was like,
like
oh,
there's
we
no way.
only take 65%
Yeah,
leverage, not
I know.
like, hey, banks are capping out at 55%, maybe 60, but that's when we start to have that recourse conversation, which
I
you don't
know, I know.
have.
It's
And
we're in a different world. We're in a
like,
different
yeah,
world.
we're in a different world. I think that's said perfectly. We're in a different
Yeah.
world,
Yeah.
but we also have to kind of, work with the stack of cards that we've been given right now, and figure out how to kind of keep putting one foot in front of the other, and hopefully make sound decisions that are the right decision now, and hopefully also becomes the right decision later.
Well, this has been excellent. I'm glad we got to talk about PACE financing, get to talk a little bit about sort of the state of the credit markets and what have you. Um, I've definitely covered everything I wanted to cover, so I want to just say thank you for your time.
Thank you.
And this is all very positive. And again, for those of you who may have missed at the beginning, northbridgeops.com. That's just northbridgeops.com. And that has been Laura Rapaport, uh, Grand Poobah, if you will, of
I
Northbridge.
don't know about that, but thank you for having
That's your
me.
new title. Thanks again, and be well.